Okay, what if I told you there's an AI that's a total game changer for trading? I'm not just talking about an AI that looks at a stock's history. I mean one that understands how all stocks are connected, analyzes trends across different timescales, and literally reads the news to figure out why the market is moving. Well, today we're diving deep into a new framework that does exactly that, and it's hitting a level of accuracy that is just staggering.
So here's what we're going to cover. First, we'll look at why the old AI models are hitting a ceiling. Then, we'll get to the big reveal, the breakthrough numbers this new framework is putting up. The real fun begins when we go inside what I'm calling the three-brain model. After that, we'll see how it stacks up against the competition and wrap up with what this all means for business leaders and, of course, the tech teams that have to make it all happen.
All right, so to really get why this new model is such a big deal, we first need to understand the problem it's solving. And it's pretty simple, really. Today's markets are just too fast, too interconnected, and way too noisy for the older strategies to keep up.
Think about it. On one side, you've got your traditional quant models, the ones built on these fixed, handcrafted rules. They're just not built for the chaotic, non-linear world we live in now. And on the other side, you've got the first wave of AI, like long short-term memory networks, or LSTMs. Now, LSTMs are pretty good at spotting patterns over time for a single stock. But here's the catch. They have a massive blind spot. They can't see the invisible web of connections between stocks. It's the classic case of seeing the trees, but totally missing the forest. And hey, don't just take my word for it. The research paper this is all based on says it perfectly. The old ways of doing things have just hit a wall. The sheer speed and complexity of the data today have created these bottlenecks that legacy systems just can't get through. And that's exactly where this new framework makes its entrance. It was literally designed from the ground up to conquer these very problems, the complexity, the speed, and all those hidden connections. And the results? Well, in backtesting, it achieved a predictive precision of 92.4%. Just let that sink in for a second. That is an almost unheard of number in a field where even a tiny edge is a huge win. So you have to be asking, what kind of architecture can pull off a result like that? How does this thing actually work? All right, the secret sauce is what I like to call the three-brain model. It's brilliant. Instead of relying on just one type of analysis, it runs three highly specialized modules at the same time, where each one is like its own brain, laser-focused on one part of the market puzzle. Let's break them down. First up is asset graph learning. This is the who. It figures out which stocks influence each other. Then you've got cross-scale temporal modeling. That's the when, analyzing trends across different time frames. And finally, macrosemantic embedding. This gives us the why, the crucial context behind big market moves. We're about to unpack every single one. Okay, brain number one. This one uses something called a graph neural network, or a GNN. The easiest way to think about it is that it builds a social network, but for stocks. It maps out how all these different assets influence each other, identifying clusters, who the leaders are, who the followers are. It gives the AI a complete structural map of the market landscape. But how does this social network get its data? This is where it gets really smart. Each stock, or node in the graph, doesn't start as a blank slate. Its initial profile is built from 13 classic technical indicators. We're talking about things traders have relied on for decades, like RSI to measure momentum or MACD to spot trend changes. So it grounds the AI's fancy network analysis in metrics that are already proven in the financial world. So now that we have the who, the second brain zeroes in on the when. This module is all about timing. It uses transformer models. Yep, the same core technology that powers things like ChatGPT. But it does something really clever. It runs 3 of them in parallel, and each one is looking at a completely different time horizon. So you've got one transformer analyzing just the last 5 data points, hunting for that immediate high-frequency chop. At the exact same time, another one is looking at 20 data points to find weekly trends and momentum. And a third is looking way out at 60 data points to spot those huge, overarching market cycles. It's seen the ripples, the waves, and the tide, all at once. And finally, the third brain, which provides that crucial context. This is where a large language model comes into play, literally reading and interpreting unstructured text. We're talking news articles, central bank announcements, policy reports. It takes all that qualitative info and turns it into a quantitative signal, basically letting the AI understand how a big world event might ripple through the market. So you've got these 3 brilliant brains working independently. How do they come together to make a single call? Well,
They all meet in what's called the fusion layer. The insights from the who, the when, and the why all get fed into this final layer. Here, they're intelligently weighted and combined to produce a single, unified, and incredibly well-informed prediction. Okay, the theory sounds incredible, but talk is cheap, right? How does this thing actually perform when you put it in the ring against other well-known models? Let's get that 92.4% score up on the scoreboard. This chart uses the F1 score, which is a really good, balanced measure of accuracy. A standard LSTM model, it comes in around 85%. Stock GCN, which is another model that uses graph networks, does better. It hits 88.6%. But our three-brain model just blows past them, hitting a 92% F1 score. This isn't just a little bit better, it's a massive leap forward. So why the huge jump? Well, let's break it down. An LSTM has tunnel vision. It's great with a single timeline, but it's totally blind to that social network of stocks. Stock GCN is a big improvement because it can see that network, but it's missing the other two brains. It doesn't have that sophisticated multi-scale time analysis, and it definitely can't read the news. This new framework wins because it does all three things at once. A 92.4% precision score looks amazing in a research paper, but what does it actually mean for the business, for the bottom line? Let's translate this incredible technical feat into real, tangible value for executives.
Okay, three big things here. First, we're talking about superior risk management. That comes straight from that social network brain, which can spot risks that ripple across different assets, risks you were blind to before. Second, it's about finding new profit opportunities, or alpha. The model finds these opportunities in the relationships between assets, not just one stock's chart. And third, it gives you real macro resilience. You're not just reacting to a news headline anymore, you're proactively adjusting because the model understands what that news means. Now, for all the tech folks out there, we know that having a killer model in a lab is one thing, but getting it to work in a live, high-frequency trading environment, that's a whole other challenge. So what does it actually take to deploy this beast?
The MLOps playbook really comes down to three non-negotiables. First, your data pipelines have to be absolutely bulletproof and automated, feeding market data, those technical indicators, and live news into the system with almost zero delay. Second, your infrastructure needs to be screaming fast. We're talking about the model making a prediction, what we call inference, in microseconds. And third, this is not a set-it-and-forget-it system. You need continuous monitoring to watch for when the market changes its behavior and automated processes to retrain the model on the fly to keep it sharp.
And all of this brings us to one final crucial thought. A model this powerful fundamentally changes the landscape. It feels like a new benchmark for performance has just been set. So the question for firms and traders is no longer if this kind of AI will become the standard. The real question is, how long can you afford to wait before you get left behind?